Okay, so welcome everybody. This is a little peek at the stock market, the options market, some strategies that I think look interesting for right now. I'm going to sound like a little bit of a recording from previous weeks because there's a few things that I'm really liking that I want to see play out, and we're going to talk about those. But in the meantime, I hope everybody's having a good week. Hopefully everyone has got a nice little weekend coming up in the U.S. We've got there's always people from all over the world. So we've got Independence Day this weekend, which is why I'm doing the webinar a little bit earlier today. I've got some Independence Day activities to attend to tonight and tomorrow and so on and so on. So I just want to kind of get to it right now and get her done. So glad you guys could make it in, and nice to see you all. Okay, here are a few things that I want to look at. Andrew, glad you could make it, my friend. Good to see you. Here's a few things I want to address and look at and so on. Now, first and foremost, those that are in my trade group, we have got some pretty intense trade recommendations coming. So I hope you guys are ready for that. We're going to attack some of those after the weekend, right? So we're going to have some good stock and option recommendations after the weekend, and we're going to dive in. So I've been watching the market, talking about a lot of things to do, and so on. And we've, a lot of people have been coming back with a lot of questions and good feedback and so on. But we're going to get some good group trades going, and I'm pretty excited about it. So should be fun. Should be fun. Yep, Mel, hope you're ready. Hope you're ready. Normal end of the week with profit, going camping. I like both of those things. Camping and profit are huge in my world. Definitely the camping part. Really like profit though too. Andrew, yeah, out there in St. Augustine. Good for you. That sounds lovely. Good. So here's a little bit of what I'm looking at, guys. Here, the stock market is, as always, a little bit of a crazy place, right? We have to just, as those of you may have seen and so on, I'm really trying to push the, I posted an update on Forex, stocks, options, cryptos, everything on my website. Head over to the website, daytradersfx.com. And I talk about this as, I call it my TCC outlook, right? And that's just, or sorry, TTC, sorry. And that's trade the charts, right? Let's just trade the charts, because right now a lot of things are just, we're in a choppy area. We're in a little bit of a situation here where it's kind of tough to tell where things are going to go, right? We have some stocks that have just kind of gone, and we're wondering when they're going to turn around, what they're going to do. We talked about the Qs. We've talked about the Qs in the past, and there's plenty more to say about these, but these guys and others. But the Qs just kind of keep going up, right? We just get everything running higher and just continuing to make a push. Tesla has made this big run, right? We were watching that $1,000-ish mark, and it just blasted right through, right? No matter how overbought Tesla looks, it just keeps running up. And Tesla looks pretty darn overbought to me, but they just, but Tesla just keeps running up. The stock just keeps going higher. It's going to get increasingly difficult to participate in these kinds of movements when we're trading stocks at all-time highs. I hate trading stocks at all-time highs. I think it's really tough. It really stinks to do. So I'm not really trying to do it that much right now. I'm just saying, you know what? I'll wait until we get, big, major, overextended signals, and then even then I'm going to wait for additional confirmation and just good reasons to get in. Tesla just seems to want to continue to head higher. They just those guys over there, our good friends over in Tesla, just they're taking no prisoners, and they're taking no breaks. Now it's interesting. Tesla has been in this channel since the low of March. So we had that big pullback in March, and then Tesla has just gone like this, right? Now this big run up right here puts it back into the top of the channel. We've hit these channel highs a couple of times, and some of these guys, but again, this is hard to participate in because we look at this and we say, where the heck is Tesla going? What are they up to? Where are they off to? You know, what's the deal here? And so it's going to get tough to participate in some of this movement. So we're going to have to be patient and wait on some of these things. And so while I'm being patient and while I'm waiting, we just have to use a little bit of regular reasoning and logic, right? Where we say, okay, Tesla's always been a crazy stock, it goes up like crazy. Apple's always been a crazy stock, goes up like crazy. Amazon goes up like crazy. Zoom is going up like crazy. You know, so on and so on, right? We got to kind of look at that stuff. Google and Netflix and these guys just kind of keep going and going and going. So there's two thought processes I want you guys to think about. Number one, if a stock is heavily overextended, be patient. Wait for a pullback. Don't try to trade into the highs. If anybody's buying Tesla at $1,200, shame. If you're buying Tesla at $1,000, you know, at least it's down at the bottom of the channel. But just when things really start to get big, huge gaps. I mean, right now, we look at Tesla. The price of Tesla is currently 47% above the daily 200 moving average. 47%. That's ridiculous. So we want to try to find stocks that have, you know, some reasonable distance between current price and the moving average. I really like things that are, you know, 10, 15, 20% at the most above the moving average. And that's something that we can look for, right? That's something that we can filter. We can go over here and we can say, okay, 200 moving average. What is something that is 10% above the 200 moving average? I click on the 10% right there, gives me 151 stocks. Apple is currently 10% or less above the 200 moving average, right? Adobe, 10% or less above the 200 moving average. But if we start to say, okay, show me something that's 20% above the 200 moving average, right? We start to really kind of slim it down. So we went from 151 to 99. And if we start looking at something like Tesla that's, you know, over 40% above the moving average, there's still some, right? Amazon is 40% above the moving average. Let's see, where's Tesla should be in here. And they are somewhere, next page probably. But you can start looking at these guys and say, okay, what do we have that's 50% above the moving average, right? Start to find some of these, and these can give us opportunities for stocks that might be getting, you know, pretty heavily overextended, stocks that might be ready to start giving us some pullbacks and so on. So those are kind of interesting things to look for, looking for stocks that are heavily above the 200 moving average, large amounts. 70%. Do we have anything that's 70% above the 200 moving average? Still 23 stocks. Good grief. Tesla? Wonder why that's saying 70%. Anyway, so there's still 23 stocks that are way up there, right? Inovio, right? This is a big pharmaceutical that everyone's super curious about. DocuSign, killing it. DraftKings, just killing it, right? Camping World, right? People have gone nuts with the outdoors, just killing it. Tesla, Teladoc, Twilio. Twilio is the company that basically is behind all the text messages you receive whenever you sign into something and they need to do some two-factor authentication. It's just Twilio. They're just using Twilio, and they're sending you a text message. So we look at all these and we say, okay, these guys are way up there. They're way extended. They're way above the moving average. You know, are they going to start to give us some pullbacks? These are heavily extended stocks, heavily extended stocks. So that's one thing to look at. But the other thing to look at as well is we want to look at the details of some of these other stocks that we can say, okay, while we're waiting for some of these are pretty expensive, right? You know, Twilio's going for, you know, $230. Tesla's obviously up in the $1,200 mark. Trade Desk is in the $400 area. You know, some of these are getting kind of expensive. You know, Inovio's at, you know, $21. That's not too bad. DocuSign's up there a good little bit, right? They're up there at almost $200 a share. So those are getting a little expensive, and some of those are a little bit tough to follow, right? We talked about Tesla, you know, being way up here. DocuSign, you know, again, way up here. Look at these spaces, right? I mean, this is off the charts, right? There's such an incredible trend here that it's really hard to participate in this. We're saying, I mean, like, is this something I really want to jump into? This looks pretty heavily up there, right? We're starting to look at some of these channels. I mean, DocuSign, you know, again, they're killing it as well. They're way up in this everybody has to use our services kind of atmosphere now, and you know, they're just killing it. But how do we participate with these guys, right? How do we say, okay, you know, maybe that's my channel right there. Maybe that's where this is going. But we just have to kind of be a little bit cautious with those, and just watch some of those. You could buy stocks. Yes, exactly, Andrew. Yeah. And Andrew, you know, to be clear, most of the things I'm going to talk about are going to be options trades, right? We're not going to buy too many of these stocks. Most don't have $1 million to trade with, right? So we're going to kind of be more in the option sphere, if you will, because, you know, that way you can participate in the options market, you know, with five or $10,000 and still make some money. Otherwise, yeah, if we're talking stocks, it's going to be tough. But even in this kind of a movement, participating with options is tricky, right? It's tricky. These things are all at all-time highs. They're showing massive overbought signals, but they just keep trending and they keep going. So that's something we have to kind of just watch for. So while that is happening, and while we're saying, okay, at least I need to at least see some sort of pullback. I need to see some sort of pause. I need to see some sign that this thing is, you know, is a company that's not going to just go out of the atmosphere and that's it. And we've missed everything, right? I mean, DocuSign has got some pretty big, you know, levels we could see pull back to in those lower areas, right? And so I don't want to be buying some of these things when they're such large percentages above the moving average. That's just too overcooked for me. I can't participate in that bullish trend. So on a lot of these, I'm going to wait. I'm going to let them calm down. I'm going to let them pull back. And I'm going to go over here to my screener. And I'm going to say, okay, while I wait for that, what if let's see how it looks over here. Now, I'll happily share my screener with you guys. But I'm just over here saying, show me U.S. stocks with 1 million shares traded daily at least, that are optionable stocks, that are mid-cap, you know, $2 billion market cap or higher. But then I can go over here and I can say, well, show me stocks under 30 bucks, right? That meet this criteria under 30 bucks. And if I say above the 200 moving average, there's 49 of them. If I say I don't care, then there is 212, right? Under $30, they have a good market cap, they have all this stuff that are still, you know, still giving us some good opportunities here. So this is where I would start if I were you guys, because the strategy I want to talk about is going to be kind of centered around the fact that, yeah, we might need to buy some stocks. We might need to hold on to some of these shares for a couple of weeks, depending on what kind of strategy and what kind of approach we take. Yes, Andrew. Yep. That's always good. But here's what I want to kind of talk about. I want to see if you guys are okay with this kind of move here, where you can say, all right, here's my screener. Here's stocks under $30, or heck, maybe we do stocks under, you know, $20. Let's say stocks under $30, because there's some, you know, a lot of the banking stocks are in the 20s, and a lot of good airline stocks are in the 20s. So let's say stocks under 30 bucks. And if we go here through our kind of, you know, filter through our sector, we've got, you know, all these different things that we want to look at here. I'm always a fan of the financial stocks, right? Under 30 bucks. And give me a break. Look how many there are. There's 33 of them. You can see AIG, Ally, Bank of America, you know, yada, yada, yada. There's just a ton of them. And so when I look at these, I think to myself, okay, which one of these am I okay owning, right? Let's just say Key Bank right here, right? Key Corp. I used to see these banks around a lot, and I don't know who they merged with in areas I've lived in, but I don't see them anymore. But they're still big, right? Key Corp. So if we go over here to Key, and we just type in Key. All right, there we go. And this chart looks basically exactly like every other banking chart. Look at Bank of America. Can you tell the difference from the stock? I mean, I can't tell the difference, except for I drew on one and I didn't draw on the other. So we're looking at these and we're saying, okay, what are the chances that Key or Bank of America or US Bank or any of the rest of these is going to go like this? And then maybe retest those lows. Well, I'd say it's a fair chance. And so what I have to ask myself then, if that's a fair chance that that could happen, what's going to be the best strategy to trade this? And this is where I'm going to sound a little bit like a broken record, because this is what I'm doing. I am looking for stocks, looking for situations. Hold on one second, guys. Hold on one moment. Just one moment. I am going to do this. So what I want to look at when I'm looking at these stocks, I say, okay, is something like this going to pay me enough money, first of all? And you guys can determine what enough money is for you. But is this going to pay me enough money to trade this in various ways? Pretty much the thing I want to encourage everybody not to do much of right now, unless you're doing kind of a day trading strategy or something, just do your best to avoid just buying calls and buying puts. That's just not the best way to go, because it's a tough market we're in, and buying calls and buying puts is just it's tricky. It's tricky. I'm sure many of you are making money doing it, but I would opt a little bit more for there we go. I would opt a little bit more towards selling options, right? Just sell the darn options. So I look at these banking stocks and I look at some of these airline stocks and so on, and I think to myself, okay, I want to sell an option, but if I go over here and try to trade a credit spread, right? And a credit spread is just saying, okay, here's Key trading at 11.70. How much can I get trading at 11.50 and an $11, right? That's a 50-cent gap. And so my risk is going to be the credit received minus this 50-cent gap right here, right? So I'm going to be risking $34 to make 16 bucks. But if I go out a little bit, can I make a little bit more money out here? 22 days doesn't look that much better, right? Kind of being in that area, make 10, risk 40. I mean, that's not that great. What if I go out a little bit more, 29 days? I'm still not doing that great. I'm still making 18 bucks and risking 32. That's not awesome. So then I would look at this and I'd say, well, does Key pay enough in premium if I just were to sell an option, right? So if I sell an option on these guys and I say, okay, here's what I'm going to do. And this is kind of the strategy that I'm doing a lot lately that I like, but it does tie up a bit of money. So you got to have some money to kind of back it up. But I'm looking at this and I'm going, I'm going to sell a naked option on Key at 11 bucks, right? 29 days, 11 bucks. Now, let's just say with this spread, I can get about, we'll just, for the sake of math, I can get 50 bucks out of this thing, right? So I can make $50 on this. I know it says my max loss is 1,050, and that's given that these guys in the next month go bankrupt and their stock goes to zero. Probably not going to happen. So I look at that and I say, okay, I can make 50 bucks. So that means if this stock drops from 11.71 down to below $11, and I let this option get exercised, which is what I want to do most of the time, then I'm actually going to own $1,100 worth of stock for $1,050. So my break even is really $10.50, even though I technically own the stock at 11 bucks. So I get to apply that $50 towards the stock that I bought. Is that making sense to everybody so far? So now I have this stock at 11, let's say it goes down to 10.50, right? Drops down to 10.50. And I'm thinking to myself, darn it, I'm down a little bit. Well, technically we're not, right? Our break even's 10.50. So if we just sold the stock at 10.50, even though it's going to say you're at a loss of 50 bucks, we have that option premium to back us up. And so now we're basically just break even. But then when we sell an option on this, our break even gets even lower, because if we're saying to ourselves, I just want to get out of this stock. I don't care if I make money, I just want to get out of this, right? And that's not the strategy of selling a naked put, but let's say this stock starts to look a little bit ugly. We don't want to stay in it, and we're just saying, look, I just want to get out of this thing. Well, we own it at $11. our break even really is $10.50 because we had to keep that $50 premium. But then if we sell an option, how much money are we going to make on that, right? If we sell an option, these guys are trading at $11.71 with a 30-day expiration. Approximately, let's just say an at-the-money option is selling for about $80. So that technically brings our break even down. So now we're saying $11, because that's the strike price we sold, but we get to keep $50, so that actually brings our break even down to $10.50. And then we sell an at-the-money option for, say, $80, and that actually brings our break even down to just below, you know, about, what does that put us at? About $9.70, right? $9.70. So our break even now is really kind of right here. So just a little bit above $9.50. Between $9.50 and $10 is our break even. So now this stock has to take a pretty good dip in the next little while for us to really get into some trouble, because we're keeping our option premium from the put we sold to get in. We're selling an option to get out, and again, depending on how desperate we are to get out, that actually brings our break even lower, and we can actually sell. So look at this right here. Look what this is selling. Basically, an at-the-money option, 30-day expiration, is selling for, you know, about $80, right? Well, if we go over here and say, I'm going to, you know, I'm going to stay in this, or I really want to get out of this, and the stock's sitting at, you know, just below $11.50, for example, and I want to sell an option to exit this. I'm not desperate, but I'm anxious to get out. Well, technically speaking, I could actually sell an in-the-money option. I could sell the $11 option. I could sell the $10.50 option. I'm just getting paid more and more, and the amount of money I'm making there is going towards my break even, and even getting me out with a little bit of profit. Does that make sense? You know, I always explain this, and everyone goes, "That doesn't make any sense at all." But do you guys get that? Does that sound reasonable? Andrew, yes, you can put a stop loss on an option. Yeah, but I'm only going to sell naked options. I'm only going to sell a naked put if it's a stock that I'm okay owning. And if I understand where all these numbers work, and I understand where my real break even is, you know, applying that put option premium received to my break even, applying that covered call I'm writing, bringing that break even lower. So yes, you can put a stop loss in and just say, hey, if this doesn't stay above whatever strike price I'm selling, just get out, take a loss. You can do that, absolutely. But I would rather say, give me the stock and I'll sell an option to get out. And between selling that put to get in and selling that call to get out, my break even can actually potentially be very, very low on the stock. Does that strategy make sense? We've talked about this a few times in past webinars, but does that make sense? Does that make sense? Andrew, yes, Tastyworks will show your break even. I mean, you'll have to do a little bit of math because, you know, because this is kind of slightly into the, you know, into the unknown, as they say. But this is the only way I can see that I want to participate in some of these cheap stocks. I don't want to buy a call on any of the airline stocks right now, any of the banking stocks that are cheap, that have potential of going up a lot. I'd rather buy a put. If I get assigned the stock, I say, hey, yeah, I'm okay holding on to the stock for a little bit. And then if it does take off, then I'll make a bunch of money, and then I'll sell calls at higher prices and end up making a lot of money on the trade. But actually, what I like to have happen is I like to, you know, here's this stock trading at $11.71. What I like to do is say, hey, I'm going to trade that $11 strike. I want this to go below $11, not a ton if possible, but go below $11. So I own the stock now really at about $10.50. If it can stay at $10.50 and I can sell it in the money or an at the money option and make $100 on that, $150 per contract, $200, then that actually turns out great. So if we can get in a scenario where we get assigned the stock because we sold a put that got exercised, and then we sell an option to get out, we can actually make about twice as much money as just selling the put and never getting assigned the stock. How does everybody feel about that? Is that somewhat coming together a little bit? You guys doing all right there? Yeah? Lenny, good. Mel, you know, we'll practice the heck out of this, Mel. I like this strategy a lot. I think it's a great way to go. You just, you know, some people say it's a lot of work for a little bit of money. Well, trading is a lot of work. And actually, it's not a lot of work. You have to click about 4 mouse clicks to get it all done. So pretty easy to do. It's not too bad. It's not too bad. Mel, is that a two-part or a single transaction? Well, it would be kind of a multi-part transaction. Yes, that's true, Mel. A lot of work is for a little is the secret to success. I love it. So it's a multi-part transaction because what we're doing is we're selling a put first of all. If the stock goes down below our strike price, we're just letting the broker exercise us, and then we own the stock, and then we're selling a call separately. So yes, I guess you could say it's a 2 or 3 part transaction, but really all our energy is selling that put, letting that option get exercised if that's what happens, and then selling a call on those shares that we were exercised and assigned to. So yes, double commissions, but if you're using, you know, most brokers' commission is so cheap now. It's so darn cheap. Tastyworks is $1 a contract. There's no fee to close, $1 to open. So in that kind of scenario, you're $2 if you're just trading one option contract. You're $2 commissions. Now they will actually, not totally true, because they'll charge you a little commission for assigning you the stock, because that's considered a stock trade. So they'll charge you a couple of bucks for that. That's right. That's right, Lenny. Better indeed, because we don't want to do one small thing and take a huge loss. That's for sure. So this is a bit of back and forth, but you know, you can just have this kind of thing running over and over and over and over again, and it's awesome. Okay, Andrew, you can lose the credit if trade goes against you or are just assigned. Yes. So no, really in this scenario, Andrew, the only time we lose the credit is if we close the option in loss, right? So if you sell this $11 put with whatever expiration, 29-day expiration, and you say, you know what, this is now below $11. I don't want to get assigned the stock. I'm going to take a $100 loss. Yeah, you'll lose your credit and you'll take a loss, right? So you'll lose the credit received plus some. But that's why we don't want to do that. We want to find stock that, number one, is cheap enough for our account that we can afford to hold 1 or 2 or 3 or 400 shares open. And number two, stock that we say, I think I'm okay owning this. I think I feel good about owning this kind of stock. And so we don't want to close that option in loss. We want to let that get assigned and own the shares. So either way, we get to keep the credit, right, that we receive, that option premium. If it expires above $11, we keep just the premium. If it expires below $11, we keep that premium, which is applied towards the shares of stock that we now own to make that break even lower, right? That makes sense? Mel, can it be set to do all at once, or do you need to watch for the second part? I mean, it's pretty low maintenance, Mel. I don't think you can set that. I mean, that's really two completely separate trades, so I don't think you can tie those together and set them up like that. But I mean, as long as you know what your expirations are, and you can go shorter expirations. I went out a little bit further on this one because, you know, because I want to maybe get a little bit more premium, and that's the only reason that we would go out a little bit further, is to get a little more premium. So basically, all we would have to do is sell the put, let it expire, get assigned, and then sell the call. So 2 actions, maybe 1 or 2 or 3 weeks apart. But I mean, Mel, you know, we're traders, right? We don't mind watching the charts and doing a couple of things, but it's not something that requires it's not a lot of work, right? We just do two transactions and that's it. Okay, Janae, either way the naked put goes, you keep the credit either. Yep, that's right. That's right. Yep. Andrew, so as long as you hold until expiration, you always keep the credit if selling options. Yes, as long as you're okay getting assigned. So, yep, as long as you're okay getting assigned, you get to keep that credit either way. Yeah, tell me about it, Mel. I hear you. I hear you. If I could keep my kids from breaking bones and hurting themselves and going crazy, I'd have all the time to trade in the world too. So yeah, life does get a little bit wild, a little bit wild and crazy. But guys, this is the strategy that I think everybody probably needs to just be doing. Now, you guys know probably by now and by this point, I loathe day trading the stock market and options. I just don't like doing that at all. I don't like doing that at all. So for those of you that are thinking, I want to have a day trading strategy for the stock market, you are talking to the wrong guy, because I do not like doing that at all. So this is something that we say, let's let this run for, 2 weeks, 3 weeks, right? How much do we need to let this run to make it worth our time to get into, right? And so that's the kind of thing I'm looking at. I see the same thing. We've talked about Delta so many darn times. I love Delta. I think Delta is a great stock, right? If we go over here and we look at Delta and we say, all right, Delta Airlines just looks like absolutely every other chart, every other banking chart, every other airline chart. Are we getting a rounded bottom where, sorry, it's a terrible drawing. Are we getting this kind of movement here that is telling us, it's go time, time to start trading this up and getting some movement out of that? Maybe, right? Maybe it is. Delta's got earnings in 6 days. That could be a big shocker. Maybe it won't be. I don't know. But I look at this and I think to myself, Delta's trading at 27.70. So if I use this strategy that I'm talking about, there's that little white circle right there is Delta Airlines. If I trade Delta, that's 15-day expiration, right? July 17th, and I say, well, how much money can I make here? That one's decent, right? I can make $100 on the $26 strike. It's only $1.72 below the current stock price, but it's also only 15 days, right? If I go out a little bit further, then a $26 strike is going to pay me about $150 instead of about $100. But let's just say I don't want to hold on to this forever and I want to kind of cycle through this whole process. So I say I'm going to sell the $26 strike. That seems to be making some pretty good money. If I get assigned this, I'm going to own $2,600 worth of Delta Airlines. But most option accounts and stock trading accounts have margins, so I'm only going to be tying up about $1,300, right? $1,300 of my trading account. And now I actually own Delta at really about $25. Yes, technically I own Delta at $26, but that $100 gets to be applied towards my $2,600 worth of stock. So I have $2,600 worth of stock for $2,500. So I really own Delta right here. And then again, if I want to sell my way out of this with a call option, I can do that as well, right? I could sell a call option at $25. Now, an at-the-money call option, we see a couple of things here. Let's go with just one strike out of the money on this call option. I can sell a 15-day call option on Delta at $28, which is higher than the current stock price, for about $150 or $160, right? So if this ends up going down to $25, which is my real break even, I can sell a $25 strike for probably around $150 or $160. I can get out of that trade, $2.75 basically lower than where it's currently trading, with still about $150 profit per contract or per 100 shares of stock. Now, if I go out a little bit further, I can get a little bit more premium. But also, if I say, I just really want to get out of this thing, well, I know that an at-the-money option is trading for, around $150. So I could actually say, all right, then that really moves my break even more to like $23.50, right? Because we said 25 is our break even, applying this $100 credit. But then if I can sell an at-the-money call option for about $150, and that really takes my break even down there to $23.50, right? Because I can apply that $150 towards just simply getting out of the trade, if that's what I want to do. I just simply want to get out of the trade. So now I'm really not taking any risk on Delta until it goes from $27.72 to below $23.50. Does that make sense? You guys with me on that? I'm just applying the two credits. I'm applying the credit from the put I'm selling and getting exercised, and I'm applying the credit that I'm selling for the call option. So my break even comes all the way down to $23.50. How do we feel about owning Delta at really having our break even at $23.50? That's this little area right down here, right? That's this guy. That's our break even on Delta. Basically, we're around the all-time lows. So that's what I would encourage everybody to do. So use a stock screener that looks like this one right here. I'm going to copy this and post and paste this into the chat. Use that stock screener. That'll show you stocks under 30 bucks, right? And I want you to start filtering through some of these and saying, what stocks that are under $30 can I handle owning? Can I handle selling a put to get exercised on and selling a call to get me out of this? Look at some of these setups. What stocks are trading around lows, right? What stocks are way down in those lower levels? Bank stocks are always interesting for me. I like watching the bank stocks. I think these guys are interesting. I think there's some good opportunity there. You know, how Bank of America is trading at 23, almost 30. You know, how could I get to a break even, a real true break even of Bank of America to maybe 20 bucks, right? Getting down to those near ultra lows. Well, I sell a put to get in, bring that break even down. I sell a call to get out, bring that break even down even more if I need to kind of urgently get out of the trade. Now, I'm talking about these scenarios that are, you know, if the stock just drops, right, and takes a dive on us, we've got a real easy way to manage getting out of this trade. There's going to be plenty of times where the stock just doesn't go down at all, and that option doesn't get exercised, and the put expires out of the money, and we just keep the premium. Or the put expires, and we get assigned because the stock price is 10 or 15 cents below our put price, which is just ideal, right? If that happens, then we say, woo, that's awesome. I'm going to now sell an option that's basically at the money, right? Because if that happens, if you sell a $26 put on Delta and you take 100 bucks, Delta runs down and expires at $25.90, right? And now you can sell a $26, you know, an at the money or slightly out of the money call option, make a pretty good amount of money, and our break even, which is $25, we're getting out at maybe 26 bucks. We get to keep $100 there. And then we get to keep another $150 there. So now we're making $250 a contract if this doesn't make too much of a dip. It just goes down far enough to exercise that option. So that's what I like. That's what I'm looking for. So are we selling a call and selling a put? What is the max loss? We're selling a put to get into the trade and get exercise stock, and then we're selling a call to get out of the trade. When you're selling a call and you own shares of stock, the only max loss we're ever worried about is if the stock goes down a bunch, right? That's, you know, if the company goes bankrupt that you're in, then, you know, you're on the hook for whatever amount of shares you own that are now not worth that. When you're selling a put, if I sell a put on Delta, they're going to say, okay, your max profit's 102 bucks, your max loss is $24.98, right? $2,498. That doesn't mean we're going to lose $2,498. It means if Delta's stock in the next 15 days goes to zero and we cannot close our trade out, then we're going to be assigned shares of Delta, basically $2,500 that are worth nothing, right? Because the stock has gone to zero. So the max loss, that's why we let ourselves get assigned, right? Because then we own the shares and we can hold on to the trade a little bit longer if we need to. So there's no max loss scenario when you own stocks and you're selling options. The only max loss scenario really is if the stock goes down a whole bunch. You know, then the options you're selling, the call options you're selling are going to, you know, max out on profit real quick, and you're going to be in trouble with the shares of stock that you own. But, you know, we want to find companies that are at least somewhat reasonably positioned and hopefully won't go bankrupt over the next month. How far out do you sell the call if you get exercised? That's always a good question. I like to sell. I want to sell a put to get in and sell a call to get out far enough out that I can make enough money on it, but not far enough out that I have to sit in it forever, right? If I'm trading a credit spread, I'm going to go 30 to 45 days out. If I'm buying just a call or buying just a put, I'm going to go 60 or 90 days out. But if I'm writing a covered call because I own the stock, I want to go out as short as I can, right? 2 weeks. 2 weeks is good. If I'm selling a put, 2 weeks. But the thing we have to look at here is if I'm selling this put on Delta with a 2 week expiration, I'm getting about $100 premium, right? I go 3 weeks out. You know, is that enough? Is that more? Is that a big enough difference that I'm going to say, yeah, that's good enough to do? I mean, it could be. I make an extra 50% on that potentially. That could be enough. I go out about a month, you know, depending on how that spread plays out, but you know, I might be able to really kind of put some bucks on that. So the difference from 2 weeks out and $100 premium versus about 4 weeks out and maybe $175 premium, you know, I just want to find that sweet spot where I'm making enough that it's worth my time, but that I don't have to sit in it too long. So 2 to 3 weeks is kind of where I try to aim. Okay, does that make sense? You guys feel okay about all that? That's what we all need to be doing. That is what we all need to be doing. Okay, guys, questions. Hit me up with questions. Hit me up with comments. I'm happy to chat about it all. This was a good discussion. I'm glad we did this. Trade credit spreads on expensive stocks, bullish or bearish. Sell naked puts on cheap stocks that you're okay owning and that you can afford to be assigned and hold on to for a couple of weeks if needed. Otherwise, you know, whatever else you want to do, go for it. But this is kind of where I think everybody needs to be. Credit spreads on expensive stock, naked puts on cheap stock, and that's it. Keep it simple. Keep it simple. Keep it good. All right, you guys, have a wonderful 4th of July weekend. Happy Independence Day to all. I am on to the next adventure, but I'm glad we had a little chance to chat about this. We're going to be doing some of the trades, some of these trades coming up in the trade group. So I'll be looking forward to doing some of these with you guys that are in my trade group. Thanks, guys. Happy to see you all. Have a great weekend, and we'll catch you guys back next week. Thanks, guys. Take care, everybody.